Hey YouTube, this is Cody, and I'm here today with a friend who I met for the very first time, Brenton Haynes, based out of Colorado. Welcome to the channel. Could you share a little bit about who you are and what you've done?
Sure. As Cody said, I'm Brenton Haynes. I'm out here in the Front Range of Colorado, Denver area. Actually grew up in Los Angeles and grew up with a very strong investment background in real estate in a family that has grown a substantial portfolio in the Los Angeles area. Currently, we own and operate about 900 multifamily units.
That's phenomenal, and so that's been through 2 generations now. How long have you guys been investing for?
So my family's been investing in commercial real estate for, I want to say 60, 65 years now.
Okay,
Yeah.
and what's your general approach on scaling? Did you start with debt? Did you do the Dave Ramsey model and pay cash? And how'd that go?
Yeah, so we structured a lot with debt, and back when we started, you could get into multifamily almost no money down, 10% down. This is back before I was born. I was born in 73, and my dad started the business and ran a large commercial brokerage and slowly scaled over time as he learned the business. And then now we focus primarily on like Class C value add 100+ units.
Yeah.
In the LA market.
And you're a real estate agent. How important has that been for growing your portfolio?
Well, I think it's really important because you're on the front grounds every day, right? So as I'm looking for property for clients, I don't compete with my clients. A lot of times I'm just in a different area or a different avenue and looking for different returns.
Yeah.
But yeah, I think it's really helped relationship-wise, finding deals, understanding deals. I analyze deals almost daily. So yeah, it helps immensely, and just it adds a different layer to just investing overall, I think.
If someone's trying to get started today, LA is pretty expensive.
It is expensive.
I mean, the returns you're getting are phenomenal as far as cash flow, but
right.
you got so much equity over there. Would it make sense for someone to start buying there, or should they look elsewhere?
I'm a fan of buying in the markets that you know.
Yeah.
It doesn't matter where you're at. People are making money in almost every market, but it really depends on your goals, what you want the property to do, and what the end game is. Now, if I don't have anything out of state per se, because I was born and raised in California, I was more of a recent transplant to Colorado. So I don't have any assets here. I'm not against it, but the machine that we have is in California, and that's the market we know. Families in it, and we probably won't leave that market either.
So you mentioned Endgame. I'm sure that's changed over time. What was the original goal?
Original goal, right, is to build passive monthly income. And then as you build the monthly income up, you realize that you're actually building generational wealth. And then so that kind of changes in. So just now is positioning into second generation, but we're already planning for the third generation. And putting guidelines and structure in place of how much we're going to leverage the portfolio, what the expectations are, and try and look and forecast for that as we look at the third generation taking over, which would be my son.
Yeah, so some people hate on second and third generation without realizing how hard it is to actually pass that on. What do you recommend for folks that are building it? Because a lot of people are building it for the first time, but they may know how to build it, but they don't know how to pass it on.
Right. So, as the generations go on, the wealth begins to accumulate like a snowball. Cash flows increase dramatically. Some of the properties we've owned for 50 years. And I think the oldest property that we have that's still in the portfolio about 1970. Right? And they cash flow like crazy, become banks. We were able to leverage them to other assets, and some of them are just flat out paid off by tenants. So it is tricky, right? So second generation's known for screwing things up, and third generation's even known for screwing that up even more if it even gets there without getting too screwed up. So it's really having a level head as you build the wealth, realizing wealth doesn't make you a better person, but it creates the opportunity. It's having the eye for the opportunity. Doors will open more for me because of the portfolio and the opportunities and the people I'm around than it ever would have in the beginning. So it's recognizing those opportunities and using those to springboard into other opportunities to get you where you want to go financially and in the investment world and building your portfolio. So remember, you're never a better person because of
Yeah.
money. Money just gives you opportunity.
Yeah, and then our last question, you mentioned earlier that you don't like to go over 50%. That's your hard cutoff for loan to value.
Right, exactly, right? Not leveraging more than 50%.
Well, what are your thoughts on my strategy for someone? They could be in their 30s, 40s, 50s even, but they're trying to get their portfolio started. What are your thoughts on the high leverage seller finance?
Right, so you're in a totally different spot, right? You're young, you have time to recover if you make those more catastrophic mistakes and learn from that, right? So a lot of this business is learning from your mistakes. That's our education as we go along. And so you are paying for your education in those mistakes, right? And sometimes you pay dearly and sometimes you don't. You know, for me in that portfolio, we have such a machine going on, we want to preserve it more. So we take a more conservative approach. And the cash flow is already there, so we don't need to get super aggressive. We're not looking for quick growth. We're looking for the right growth. And it could take us 5 years to find a deal.
Yeah, but if you were your age and you didn't have the portfolio, because I mean you've been building this for a long time.
Right.
If you were in your 40s, 50s, and you were starting out, would you look at the leverage piece a little different?
I definitely would look at the leverage piece a lot.
Even
I advise my clients
okay.
differently, right? Everyone's risk tolerance is different in this business. So it's understanding risk and mitigating risk. And so every deal has its different risk. If 2 10-unit buildings could have 2 different risks involved depending on location, condition, and acquisition costs.
Yeah.
So you really have to understand your risk even in a low leverage portfolio because it's got a cash flow.
Yeah.
It's got to make, you're in this business to make money. If it doesn't make, we're not running a charity. We don't provide free housing. That's not what our business model is. There's nothing against that. It's just that's not what we're structured to do, right? We're not a nonprofit. So it has to make money and the deal has to make sense. Everyone's risk tolerance is different. I advise my clients that are my age, that are looking into it, you have to put in the energy and the effort and time, and it's going to take a lot more energy in the beginning, and you're going to take a lot more risk.
Well, that brings up one more question, actually, that I didn't think about. There's a lot of people trying to buy in the Midwest just for cash flow. And I mean, you've amassed not only a bunch of units, but a large dollar figure behind your portfolio.
Right.
There's a lot of people that just want to buy for cash flow. Why is that right or wrong? Or, I mean,
sure, I
could
think
that hold you back?
What people don't really talk about is the 4 returns of real estate. Right? There's 4 returns. Cash flow is one of them. Appreciation is one of them. Equity buildup, so that's your tenants paying your loan down.
They're nice people.
Right, and they're really good people. And tax shelter, right? So it's really trying to find that balance of all 4. If you're fixated on cash flow, you're going to make the money. But if you hold that property, like let's say in the Midwest, you buy it for $100,000 and in 10 years you sell it for 110, you're missing out on a tremendous wealth building opportunity, which is appreciation. And that's one thing that's always great about the LA market is the appreciation's always been there. Colorado's great with appreciation. There's other markets with that. We just don't dive into all the different markets because we're laser focused. I think what people get lost in is the laser focus. You need to know, eat, breathe, sleep your market. I don't know the Houston market because I'm not in it. Owning one property isn't going to make me understand that market. I need to be in it. I need to drive it. I want stuff in my own backyard. I go to LA all the time, right? And I have family that drives it. We know all the properties there. We know all the owners. It's relationship business. We know when to strike and get that deal.
That's awesome.
So that to me, I think is what's missing in a lot of these segments of what people are talking about. They chase the cash.
Yeah.
Cash is great, but here at the end of the day, if you give most people $1 million, they're going to blow it. So if you get $1 million in cash flow, nobody's going to know what to do with it.
Yeah.
Right. But if you had $1 million in appreciation that you could 1031, it's a little bit more disciplined.
Right.
Yeah.
Well, do you have anything else you want to share with the YouTube and the Facebook?
I would say keep plugging away, keep at it. This is not an easy business. But it's not a hard business either. You just got to understand it, understand the language that's used, And just remember, the arithmetic is third grade. Don't get lost in the fancy analysis of property. At the end of the day, it's simple arithmetic. We are cost per unit buyers because we know what a cost per unit will go with a certain unit mix, and we know what rents we can obtain. Period. We don't care cap rate. We don't care GRM. We don't care about a lot of that stuff. We look at it, but we weigh more on cost per unit, which is against the norm of most investors.
I got a lot of hate on Bigger Pockets from saying I don't really care about the cap rate. So
Yeah, everyone's focused on cap rates, and that's the big thing out there, and they think that they're savvy when they talk about cap rates, and it is an important indicator, don't get me wrong, but it's not the only indicator, and it may not be the heaviest weighted indicator for us because we just know that market. But if you're dancing around other markets, you're going to rely more on cap rates because you don't understand the market. It's a good indicator. It's not the only one.
well, I appreciate you hopping on the channel today.
I
That's
appreciate you
awesome.
coming out all the way out to Colorado to quote unquote have some coffee.
By the way, guys and gals, this was originally supposed to be a coffee meeting, and he had a party. So he said, "You're not flying all the way for coffee. Come to the party."
Come to the party. So I live on 42 acres in Colorado. So we had a big ranch party. I don't know, we had about 100 people here, and we do redneck style, hang out in the garage and
Yep.
eat some tacos and just hang out.
Yeah.
So
And what I share with everyone here is that it takes one phone call to build these relationships. We met online on Facebook
Yep.
a couple years ago when I had 24 apartments, stayed in touch, and here we are meeting, and I get to go learn from him.
Yep.
And so it is that simple.
And we had like 750 units, and we added like another 120.
Yeah. It's phenomenal. But-
which we got essentially for free.
Yeah.
All our money back. We had no money out of. I'll say we had no money out of pocket on that deal.
Burr
So-
deals are a lot easier on bigger deals. Everyone wants to start with Burr. It's like, go get some big stuff first.
Well, yeah. I mean, there's so many different ways to skin a cat, and you can't look at every deal with the same business model too. You gotta be able to identify that value add to help increase that rent.
Yeah.
That's really where it's at. Have it be adding storage, parking, turning over units, something in the common. I mean, there's so many ways to add value to a building.
Yeah, we're doing our first storage deal right now. We're adding storage on the back of multifamily. But yeah, that is it for today's YouTube video. So we'll probably do more with Brenton, but stay tuned and we'll see you guys next time.
Have a good one, guys.
Cool.
Awesome.
That was a good video.